So what is ROIC? Well, it stands for Return on Invested Capital. But what is it and why it's such an important metric, and most importantly, how can we use this metric to value and analyze a company? But the first question is, what is invested capital? Well, invested capital is the money that the company raised by selling securities, such as bonds or stock. So it's money that the company got externally, basically your money if you're invested in that company. So what does return on invested capital really tell us? Well, it tells us a lot about the management. It's an overview of how well the management is doing, how well it is allocating capital in some other investments and projects. So basically, if the return on invested capital is 20%, that tells us that for every $100 in invested capital, the company gets extra $20. But is it high? Is it low? What do we compare it to? Well, there are basically two things we can do with it. We can compare it to an average return on invested capital in that segment of the market, or we can compare it to the cost of capital. And what we want to find is that return on invested capital is higher than the cost of capital. If it's lower, that means that the investment is not really working and that the business is not sustainable. So to find the cost of capital, we use something called WACC, Weighted Average Cost of Capital. And what it is that the cost of capital is divided into different segments, and every segment is proportionately weighted in this equation. So if we have a company that has a return on invested capital of 20% and weighted average cost of capital is 15%, then the result is 5%. So after all the costs, we get $5 for every 100 that is invested. If we look at the Coca-Cola company, their return on invested capital is 11% and the weighted average cost of capital is 7.3%. So the result is 3.7%. So for every $100 that is invested into Coca-Cola, after all the costs, we get $3.7. So the return on invested capital tells us a lot about the company, its health, how it's doing, and mainly about the management, how it is allocating the capital. But there is one very significant limitation to ROIC. And that is the fact that if we look at it in a short term, it can be really misleading, because the company can do one not reoccurring very big deal and it gets a lot of money and the return on invested capital skyrockets. But then it goes down. So for a short amount of time, the return on invested capital can be incredible. So we have to watch out for that. We should look not only at the current return on invested capital, but also at the history of it and look at the average return for 5 years or even 10 years. So that's it for today. Thank you very much. I hope this video was helpful and interesting. And if so, then please like it, subscribe if you haven't already, and see you in the next one. Bye bye.